Okay, let's unpack this. We are diving into, well, the pretty complicated world of Citigroup's fourth quarter and full year 2025 earnings results.
It's a lot to get through.
It is. And if you, our listener, have ever tried to follow a massive bank during a total strategic overhaul, which is exactly what Citi is doing, you know how confusing it can get? It's sort of like trying to judge the speed of a Formula One car while, the pit crew is changing all four tires and repainting it at the same time.
That is a perfect analogy, and our mission here is exactly that, is to cut through all of that complexity in the financials.
To separate the engine's performance from all the cleanup work happening around it.
Exactly. We have to filter out what they call notable items, all that noise from strategic exits, the Russia impact, the sale of the rest of Banamex.
Right.
And we need to answer the real question. Is this new strategy, the one focused on 5 core businesses, is it finally showing clean, strong, underlying performance?
Well, the headline hook from CEO Jane Fraser seems to point in that direction. She said 2025 was a year of significant progress. Right. And she highlighted that the engine, those 5 core businesses, all hit record revenues and positive operating leverage. That really suggests the strategy is paying off.
It does, but we have to be so careful with the context. We're constantly comparing 2 different worlds here.
The reported results versus the adjusted?
Exactly. The reported numbers, which have all the messiness of the cleanup, and then the adjusted results, which really isolate the performance of the core businesses they're trying to build for the future.
So we have to use that adjusted data to really test her significant progress claim.
We have to.
Okay, let's jump into the full year 2025 financial overview, starting right there. You said filtering is critical. So what's the actual gap between the reported performance and the underlying story?
The difference is striking.
Yeah.
It really is. And it's why just reading the headline reported figures gives you an incomplete picture. It's almost misleading.
How so?
Well, you look at the reported numbers, and full year 2025 revenues were $85.2 billion. That's up 6% year over year.
Which is
It is solid. But if you exclude those notable items, so you're only looking at what the core bank generated, that revenue number actually climbs to $86.4 billion.
So a healthier 7% growth.
A full percentage point higher.
Okay. A 1% difference in revenue growth isn't nothing, but where does that gap become really, really big?
Net income. This is the clearest example of the drag from the cleanup.
Okay.
Reported net income was $14.3 billion. But when we adjust it, strip out all the losses and charges from the divestitures, the underlying net income from those core 5 businesses was $16.1 billion.
Wait, hold on. That's almost a $2 billion difference.
It is. And year over year, the reported growth looked pretty slow. But that adjusted figure, that represents a massive 27% increase.
27%.
Yeah. And if you miss that 27% growth figure, you totally miss the real improvement in the operating model. The engine is running much, much faster than the headline number suggests.
That 27% adjusted growth is a huge signal. But, growth is one thing, efficiency is another. Did they actually get leaner while they were growing?
They did, which confirms the positive operating leverage the CEO mentioned. The efficiency ratio improved by 170 basis points to 64.7% reported.
And adjusted.
Even better. The adjusted efficiency ratio, so focusing purely on the core operating costs, was 63%. So yes, they are actively streamlining, they're consolidating tech, and they're finding real productivity savings.
And that's even while they're still funding all these huge transformation efforts.
Exactly.
Okay, so efficiency and net income are great, but the ultimate metric for you, the shareholder, has to be return on tangible common equity, the ROTCE.
Absolutely.
That's the real yardstick.
It is, and on a reported basis, ROTCE for the full year was 7.7%. Acceptable, but, not stellar.
But the key, again, is that adjusted lens.
Exactly. When you apply that excluding notable items filter, the ROTCE jumps to 8.8%.
So that's more than a full percentage point higher?
It's a 180 basis point jump, and that jump is probably the most compelling proof we have that the focus strategy is paying off. They're moving towards their 2026 targets.
I see the progress, but I have to push back a little here. They're doing this massive transformation, right? Modernizing tech, complying with consent orders.
All costing billions.
Billions, yet they still returned over $17.5 billion to shareholders. $13.25 billion of that was share repurchases.
Right.
So is management signaling that the costs are now predictable enough that they can confidently do these huge capital returns?
Oh, that's a great question. And yes, they are absolutely signaling confidence. That huge buyback program is very accretive to book value, and it shows they're comfortable with their capital buffer.
And what does that buffer look like?
Their CET1 capital ratio is at 13.2%. That's about 160 basis points above the regulatory requirement.
So that's their dry powder.
That's their dry powder. It tells us they have the flexibility to fund growth, handle surprises, and keep the transformation going without having to go to the market for more capital.
So the foundation is set. But how are the 5 individual engines actually running? Here's where it gets really interesting. Let's look at the drivers in those 5 core businesses.
And just to remind everyone, the goal here is to be the top partner for clients with cross-border needs, a global wealth leader, and a valued U.S. consumer bank.
And did they deliver?
The big story is that all 5 businesses, services, markets, banking, wealth, and U.S. personal banking, all of them hit record revenues.
Record since when?
Since the current segment structure began back in 2021. And they all had positive operating leverage. It was a clean sweep.
Okay, let's start with services. That's TTS and security services. TTS has always been sort of the crown jewel for Citi, right, because of their global network.
It is.
So what metrics tell us they really extended that lead in 2025?
Well, first, services revenues grew 8% year over year if you exclude the Russian noise. But the real insight is deeper. TTS hit the #1 market rank, and this is critical. They gained about 95 basis points of market share. Wow. In that large corporate and financial institution segment, this isn't just a win. It's them proving that their global payments network translates into real, sticky client loyalty.
So what's making it sticky? You mentioned innovation earlier.
That's the driver. They're moving beyond just traditional cash management. The sources pointed to specific things like their token services integration with 247 USD clearing.
Which is a tangible tech advantage.
It's a real example of using tech to increase speed for clients, and that deepens their competitive moat. And then security services also had a great year. Assets under custody and administration were up 24%.
Huge. Okay, moving to markets. Trading can be so volatile, so that 11% full-year revenue growth is pretty impressive. What kept that stable?
In markets, it was all about technology and risk management. The 11% growth came from better electronic trading across FX, equities, and rates.
So using machine learning?
Yes, deploying machine learning specifically to get lower latency pricing and better execution. They're winning trades because they're faster and have better risk models, not just because the market was volatile.
And did that tech edge show up in any specific high-growth areas?
It definitely did. We saw huge momentum in their prime brokerage unit. They hit record prime balances, up more than 50% year over year.
50%.
Which shows that those really sophisticated institutional clients are trusting Citi more and more with their complex trading needs.
Okay, let's turn to banking. This one saw the most explosive growth, revenue up 32% year over year. Where did that come from?
It was a fantastic year for banking. It was driven by corporate lending and a big comeback in investment banking fees, which were up 20%.
And that means they took market share.
It does. They increased their wallet share, their piece of the total fee pie, by about 30 basis points.
And if we break that down even more, where was the real heat?
The momentum was in advisory fees. They spiked 53% year over year. This was mostly M&A.
Okay.
It shows that as the deal environment heated up, Citi's focus on institutional clients let them grab major advisory mandates. They proved their relevance.
Next up, wealth management. Always a critical, steady business. Revenue's up 14%, but what about the margins and the flows?
The margin is the key thing to watch. They hit an EBT margin of 22% for the full year. That's a sign of a really profitable, scalable model taking shape.
And the organic growth, new money coming in.
Strong. They delivered an 8% organic growth rate in net new investment assets, or NNIA.
And for the listener, what does 8% NNI growth really mean?
It just means clients are actively moving new money to Citi's platforms at a very healthy clip. It's not just market appreciation.
Got it.
And you see it in the total. Their client investment assets grew a very strong 14% year over year. They're attracting and keeping wealth.
Okay, finally, their home turf. U.S. personal banking. Revenue growth here was a bit slower at 5%. How did they manage that in such a competitive market?
USPB was all about expanding and improving their cards portfolio. The big achievement was rolling out new offerings like the Strata family, AA Globe, and the refreshed Costco Anywhere programs.
And that drove new customers.
It generated 13 million new card acquisitions in 2025.
13 million. That's a huge volume.
It is, and it sets them up for future interest income growth.
And the old branch network?
Well, the focus is definitely digital and cards, but on the retail side, they're still very competitive. They rank #1 in the U.S. in deposits per branch.
So physical footprint they do have is highly efficient.
Highly efficient and optimized, yes.
Okay, so a clear story here. 5 core businesses, all running well, hitting record revenues, driven by tech and focus. It's a very promising picture.
It is.
But we can't talk about Citi without talking about the other side of the coin. The massive, expensive, ongoing transformation and all the strategic cleanup.
Right. And that operational transformation is maybe the biggest de-risking story for the whole company. Management says over 80% of the programs are now at or near their target state.
But does that just mean they're checking boxes? Are there tangible results that prove this is more than just compliance work?
Absolutely. The simplification is real. They retired or replaced 548 applications in 2025 alone.
That's 9% of their entire legacy IT system.
Gone. And they're seeing real benefits from AI. Over 180,000 employees are using AI tools, and those tools helped 1.5 million automated code reviews.
That's productivity being hardwired into the system.
It is.
And on the regulatory side, which is maybe the most important measure of success here, was there any movement on those consent orders?
A major milestone was hit. The OCC terminated its July 2024 amendment to the 2020 consent order.
So that's a tangible sign that regulators are seeing the improvement.
It's the first major sign, yes. There's still work to do, but it shows the foundational fixes to risk and data are being recognized.
Okay, now we have to address the elephant in the financial room. The divestitures that keep muddying the P&L. This is where those notable items become real dollars.
Yeah, the biggest one in the fourth quarter was Russia. The held-for-sale accounting treatment led to a $1.2 billion pre-tax loss as they continued to wind down.
And that's just the cost of getting out of a difficult market.
It is.
And the Banamex sale also closed, but the accounting on that was incredibly complex. It resulted in a $1.7 billion increase in stockholders' equity. How does a sale loss lead to an equity increase? It sounds completely backwards.
It is pure accounting mechanics, and we need to simplify it. Think of it like this. For years, Citi had this huge operation in Mexico, and due to currency swings, they built up a large unrealized loss, a kind of phantom loss on their balance sheet.
And a technical reserve account called the CTA.
Exactly, the currency translation adjustment. So it was this old unrealized currency risk just sitting there.
Hiding on the balance sheet.
Right. When the 25% stake sale closed in December, accounting rules forced them to finally reclassify that old phantom CTA loss. It essentially moved off their core capital account.
So the $1.7 billion equity increase isn't new cash. It's just a balance sheet cleanup that makes their equity look stronger because a pre-existing technical loss was finally dealt with.
That's the perfect way to put it. It's an accounting cleanup, not a profit, but it does improve their stated capital position, at least temporarily.
Okay, so back to the P&L drag. Even as the core is accelerating, these legacy franchises, the businesses they're exiting, are still costing them a lot of money.
They are the ballast holding the reported numbers down. The legacy franchises, combined with corporate other, had a huge revenue decline and accounted for a staggering net loss of over $4.4 billion for the full year.
$4.4 billion.
That one number really highlights the drag from those exits, and it shows exactly why we have to look at the adjusted numbers to see the real performance.
Before we get to the outlook, just a quick check on credit risk. With all that card growth, what are the trends in asset quality?
Total non-accrual loans did go up. They rose by $0.9 billion or 35% year over year to $3.6 billion.
Across the board.
Both. Corporate NALs were up 45% and consumer NALs were up 24%. It really reflects a normalization of credit risk after the pandemic lows.
But the key is being transparent about it. Did they give forward guidance on expected losses?
They did, which shows confidence in their risk models. For branded cards, they're guiding to a 2026 net credit loss range of 3.5 to 4%.
And for retail services?
A bit higher, as you'd expect. The guidance is 5.75 to 6.25%. This gives us critical context on what they expect going forward.
So what does this all mean? We've seen strong fundamentals in the 5 core businesses, but they're overshadowed by these costly, complicated cleanup expenses. What's the definitive outlook for 2026?
The primary goal has not changed. It's all about proving the strategy works by hitting their key financial target.
Which is that ROTCE of 10 to 11%.
10 to 11% in 2026. And that target is still calculated excluding notable items. It relies entirely on the execution of the 5 core businesses.
And to get there, efficiency has to play a huge role.
It's central. They're targeting a big drop in the efficiency ratio down to around 60% for 2026.
And that comes from, what, lower transformation costs?
2 things. First, yes, lower transformation expenses as those programs wrap up. And second, actually realizing the productivity savings from all the tech investments we talked about.
Okay, so where does the growth come from next year, especially on net interest income? Will high rates keep helping?
NII, excluding the volatility in markets, is expected to grow 5 to 6%.
And the drivers are?
Strong loan growth, especially in cards and wealth, and continued deposit growth in services and wealth. And they'll also get a kind of mechanical tailwind from their investment portfolio.
Explain that mechanical tailwind.
Sure. About 30% of their securities portfolio is set to mature in 2026. Because those were bought when rates were much lower, they can now reinvest that money into much higher-yielding instruments.
Providing a nice, predictable boost to NII.
A meaningful boost. But you can't ignore the macro picture. That growth is expected to be partially offset by anticipated rate cuts.
Right, which will eventually compress lending margins.
Exactly.
Okay, so to synthesize this whole deep dive, Citi is successfully executing its focus strategy. The 5 core businesses are driving strong revenue and positive operating leverage. The story 2025 is really about that core momentum.
Precisely. The core business is hitting record revenues and showing it's on track for that 10 to 11% ROTCE target on an adjusted basis. But the structural reality is that the legacy franchises are still a massive drag, over $4.4 billion in net losses in 2025.
Which brings us back to that central split. The transformation is working, but the cost of the cleanup is still enormous.
It is.
So the question for you, the listener, to consider is this. At what point will the momentum from the 5 core businesses become so overwhelming that it fully absorbs that remaining $4.4 billion drag, allowing that crucial 10 to 11% ROTCE target to be achieved not just on an adjusted basis, but on the reported basis that every single investor reads? That is the final milestone that Citi still needs to cross.